If you step back and ignore the headlines for a moment, the real story in silver right now is not the daily candle, it's not the 5-minute chart, it's not even the latest margin hike, it's the spread. Shanghai is paying more than $10 above Western pricing for the same ounce of silver, same metal, same atomic structure, same global commodity, yet one side of the world is valuing it meaningfully higher than the other, and that's not a random glitch. But before anyone jumps to dramatic conclusions, let's anchor this properly. A regional premium does not automatically mean the system is collapsing. It does not automatically mean paper markets are fraudulent. It does not automatically mean silver is about to explode. What it does mean is friction, and friction is where stress begins. Right now, Western silver futures are trading under visible pressure. Volatility has been elevated. Cross-asset markets have been unstable. Bitcoin has seen waves of liquidation. Equity indices have experienced sharp rotations. The dollar has fluctuated aggressively. Margin requirements in metals have been adjusted in response to volatility. That environment hits leveraged futures positions first. Paper reacts instantly to liquidity conditions. Now look at Shanghai. Shanghai pricing is not immune to volatility, but it is influenced by a different mix of participants. Domestic industrial demand, regional investors, physical traders, refiners, fabricators, capital operating under different regulatory and currency structures. So when liquidity stress hits New York and London, futures contracts can drop quickly because capital is being pulled. But if buyers in Asia are absorbing metal, securing supply, or holding inventory rather than liquidating, pricing can remain firmer there. That's how you get two prices. One side pricing liquidity, the other side pricing availability. The spread between those two is the signal. Now let's dissect the mechanics of why a $10 difference matters. In a fully frictionless global commodity market, arbitrage closes gaps rapidly. If silver trades at $90 in New York and $100 in Shanghai, traders theoretically buy the cheaper venue and sell the more expensive one, compressing the spread. But that theoretical arbitrage depends on conditions being smooth. Metal must be deliverable. Settlement standards must align. Currency conversion must be efficient. Capital must move freely. Regulatory constraints must be manageable. Logistics must be timely. If any of those variables tighten, arbitrage becomes slower or more expensive. When arbitrage slows, spreads persist. Now, a persistent premium does not automatically equal systemic failure. It can reflect import quotas, VAT structures, capital controls, FX differentials, position limits, delivery rules, or temporary supply bottlenecks. But persistence combined with other signals becomes meaningful. So the real question isn't, is Shanghai higher? The real question is, what else is happening simultaneously? Let's talk inventories. In Western futures markets, vault silver is categorized primarily as registered or eligible. Registered silver is specifically available to settle futures contracts. Eligible silver is stored metal that meets specifications but is not necessarily committed for delivery unless converted. If open interest remains large relative to registered inventory, stress potential increases. You don't need 100% of contracts to demand delivery to create strain. Even 25% to 30% can apply pressure if registered stocks are thin relative to outstanding claims. Now imagine that environment during volatility. If Western futures are declining due to macro liquidity stress, but delivery interest remains firm and registered stocks do not expand meaningfully, that's tension. If at the same time Shanghai maintains a 10+ish premium, that tension becomes more visible. Again, this is not collapse, this is pressure. Now layer in margin mechanics. Exchanges raise margin requirements when volatility rises. That's not sinister, it's risk management. Clearinghouses must protect against counterparty risk, but higher margins increase the cost of holding futures positions. When traders cannot meet higher margin requirements, they are forced to liquidate. Forced liquidation pushes price lower. Lower price increases volatility. Higher volatility justifies further margin tightening. That feedback loop is mechanical inside the paper market, but margin hikes do not create more physical silver. They only affect leverage. So if Western futures decline due to margin-driven unwinds while Shanghai pricing remains elevated, the divergence reflects liquidity stress rather than pure supply-demand collapse. Now let's bring in cross-asset behavior. In recent cycles, Bitcoin has often acted as a risk barometer. When crypto markets unwind aggressively, leveraged capital de-risks across asset classes. Metals futures can get caught in that liquidation cascade. Equities selling, silver futures often sell, dollar strengthening. Silver futures face pressure, real yields rising, precious metals typically struggle. These are macro forces. They influence paper pricing more than physical availability. So if silver futures in the West are trading at $90 while Shanghai trades near $100, that divergence could be telling you liquidity pressure is dominating in one region while physical absorption remains active in another. But again, this must be confirmed. Because spreads without confirmation are noise. Spreads with confirmation become structure. Let's explore what confirmation would look like. If Western registered inventories continue declining during price weakness, that's notable. If delivery percentages remain elevated relative to historical norms, that's notable. If Asian physical premiums remain sticky rather than collapsing quickly, that's notable. If arbitrage channels appear slow to compress the gap over multiple settlement cycles, that's notable. When these signals align, structural stress becomes more plausible. Now consider industrial demand. Silver is not just a monetary asset. It is heavily used in solar panels, electronics, AI infrastructure, EV components, and medical applications. Industrial users care about supply continuity more than short-term price fluctuations. If industrial demand remains firm while speculative paper positions unwind, physical tightness can persist even during price weakness. That tension can show up as regional premiums. Now we must address balance. It is entirely possible that the premium narrows because Shanghai softens. If liquidity stress deepens globally, if equities fall sharply, if credit spreads widen significantly, if the dollar strengthens further, even physical markets can feel pressure. In a severe global deleveraging event, almost everything sells initially. Spreads can widen before compressing. Short-term price behavior does not invalidate long-term structure. This is where time frame becomes critical. If you are trading intraday with leverage, volatility is your primary risk. Margin mechanics matter. Technical levels matter. Liquidity flows dominate. If you are allocating capital over years, structural trends matter more. Inventory, supply deficits, industrial growth, sovereign diversification, two different lenses. Now let's model the possible forward paths clearly. Scenario 1. Liquidity stabilizes. Bitcoin bases, equities calm, dollar softens, volatility cools. Western futures grind higher, the spread compresses upward. New York catches up to Shanghai. That would suggest liquidity stress was temporary and price discovery remains cohesive. Scenario 2. Liquidity deteriorates. Dollar strengthens further, equities weaken, crypto sells off again. Western futures remain suppressed while Shanghai holds firm. The premium widens beyond $10 persistently. At that point, participants begin questioning which benchmark reflects real supply-demand conditions. Scenario 3. Regional premium collapses. Shanghai softens significantly. Premium compresses quickly. Arbitrage flows normalize. This would suggest the premium was driven primarily by temporary regional factors rather than structural strain. All three are possible. The difference lies in confirmation data. Now let's examine psychological dynamics. Markets often experience sentiment inversion during structural transitions. At similar price levels months ago, sentiment was optimistic. Today, at comparable levels, sentiment is cautious or fearful. Same metal, different emotion. Sentiment inversion can signal internal repositioning, but sentiment alone is insufficient. We need measurable flow, inventory behavior, delivery ratios, premium persistence, cross-asset stabilization. These are measurable. Now let's address a deeper structural nuance. Western futures markets are heavily financialized. A large portion of volume is driven by speculative capital-seeking price exposure rather than physical settlement. Shanghai markets may reflect a different participant mix with potentially stronger physical linkage. This difference in market composition can amplify divergence during stress. That does not make one real and the other fake. It makes them reactive to different variables. Paper reacts to liquidity first. Physical reacts to availability first. When liquidity stress and physical absorption occur simultaneously, spreads widen. Eventually, they reconcile. Because long-term global commodities cannot sustain large, persistent price gaps indefinitely without structural adjustments. Reconciliation can occur through price movement, or through inventory shifts, or through regulatory adjustments. But it will occur, and when it does, it is rarely subtle. Large, persistent spreads tend to close decisively. Now let's speak plainly. Shanghai paying $10 above Western pricing is not proof of systemic collapse, but it is not meaningless either. It is a stress gauge. Stress gauges deserve attention. They are early indicators. Sometimes they fade quietly. Sometimes they precede significant repricing. The key is discipline. Watch the spread across multiple sessions. Watch inventory trends. Watch delivery behavior into major contract months. Watch cross-asset liquidity signals. If liquidity stabilizes and the spread compresses upward, Western futures will likely rise. If liquidity deteriorates and the spread widens, structural tension increases. If the premium collapses quickly, the stress was temporary. This is not about hype. It is about reading signals correctly. Same metal, two prices. That is not chaos, that is friction. And friction is information. If you are leveraged, volatility is your primary enemy. If you are unleveraged and disciplined, volatility is information. Know your time frame, know your risk tolerance, watch the spread. Because when the paper version and the physical version reconcile, it will not happen quietly. It will move with force. Until then, treat the Shanghai premium for what it is, a potential stress signal, not a guarantee, but far too large to ignore. In the West, it's trading around the low 90s. Futures are reacting to liquidity. Algorithms are reacting to volatility. Funds are reacting to cross-asset stress. In Shanghai, the same metal is pushing toward $100. Same ounce, same purity, same global supply chain, two different prices. And when that happens, you don't ignore it, but you also don't overreact to it. You study it, because divergence in major commodity benchmarks is not common. And when it persists, it usually reflects friction somewhere in the system. Let's break this down calmly and precisely. The West trades silver primarily through financial instruments, futures contracts, ETFs, swaps, derivatives layered on top of derivatives. The volume is enormous, the leverage is significant, and the reaction speed is instant. When macro risk hits, when the dollar strengthens, when treasury yields rise, when equities sell off, when Bitcoin drops sharply, silver futures often get sold regardless of whether physical demand changed that day. That's liquidity pricing. It's not about whether factories stopped using silver. It's about whether capital is being pulled from leveraged positions. Now compare that to Shanghai. Shanghai's pricing structure reflects a different participant base. Domestic industrial demand, physical trading desks, institutional capital operating under different regulatory and currency systems. If buyers there are securing metal for industrial use, inventory allocation, or capital protection, they are responding to availability, not necessarily to short-term macro risk. So you end up with two lenses. The Western lens pricing liquidity stress, the Shanghai lens pricing metal access. That divergence can exist temporarily, but when it reaches more than $10 on a $90 commodity, and it stays there, that deserves attention. Now here's where we need to be intellectually honest. A regional premium does not automatically mean the global system is failing. It does not mean Western price discovery is broken. It does not mean silver is about to explode upward. There are practical reasons premiums can exist. Tax structures differ. Currency exchange rates fluctuate. Capital controls can restrict flows. Import quotas can limit supply movement. Delivery specifications may not align perfectly. Settlement timing can vary. All of these factors can create temporary distortions, but temporary distortions usually correct themselves quickly. When they don't, when the premium persists across multiple sessions, it tells you there is friction. And friction in financial markets is rarely random. Let's talk inventory. One of the most misunderstood aspects of futures markets is the difference between registered and eligible silver. Registered silver is available for delivery against futures contracts. Eligible silver is stored metal that meets specifications, but is not necessarily committed for delivery. If open interest, the total number of outstanding futures contracts, remains large relative to registered inventory, the system becomes sensitive to delivery demand. You don't need every contract holder to demand delivery to create stress. If even a quarter of open contracts stand for delivery during a tight inventory cycle, pressure builds quickly. Now imagine that situation combined with persistent physical premiums in Asia. If Western futures are under pressure from liquidity unwinds, but physical metal is being absorbed in the East, the pricing gap becomes more understandable. Not because one side is fake, but because one side is leveraged. Paper reacts faster than physical. Now let's bring in margin mechanics. When volatility rises sharply, exchanges increase margin requirements to protect clearing stability. That forces traders to post more capital to maintain positions. If they can't, they are liquidated. Liquidation pushes price lower, lower price increases volatility. Higher volatility justifies higher margins. That feedback loop can drive futures below levels that physical markets might consider equilibrium. Again, this does not mean the physical market is tight beyond doubt. It means paper markets can overshoot. Now let's layer in cross-asset contagion. In the last several cycles, Bitcoin has acted as a forward indicator of risk appetite. When crypto markets unwind aggressively, leveraged funds often reduce exposure elsewhere, including commodities. Silver futures, being highly liquid, can become a source of cash during liquidation waves. Equity sell-offs can have the same effect. When hedge funds reduce gross exposure, they sell what they can sell quickly. That includes metals futures. So if Western silver trades down to $90 while Shanghai holds near $100, part of that divergence may reflect macro deleveraging rather than collapsing physical demand. That's important, because liquidity events can distort pricing temporarily, but they don't create or destroy industrial demand overnight. Now let's zoom into industrial fundamentals. Silver demand is heavily influenced by solar production, electronics manufacturing, EV growth, and AI infrastructure build-out. Those trends do not stop because futures markets are volatile. Factories operate on procurement cycles. Manufacturers hedge supply months in advance. Industrial buyers care about continuity. If physical metal remains in demand while speculative positioning unwinds, regional premiums can emerge. Now let's address the big question. What would make this spread truly structural? Persistence plus confirmation. If Western registered inventories continue declining while Shanghai premiums remain firm, that strengthens the argument of physical tightness. If delivery percentages rise above historical norms for multiple contract months, that strengthens the case. If arbitrage fails to compress the spread over several settlement cycles, that suggests deeper friction. But if inventory stabilizes, delivery percentages normalize, and premiums compress quickly, then the divergence was temporary. This is why discipline matters. Now let's think forward. If liquidity stabilizes, if the dollar softens, if equity markets base, if Bitcoin finds support, Western futures can rebound quickly. Paper markets move fast on liquidity relief. If that happens, the spread compresses upward. New York catches up to Shanghai. That's one resolution path. If liquidity worsens, if macro stress deepens, if risk-off accelerates, Western futures may remain pressured. If Shanghai holds firm during that, the spread widens. At that point, participants begin to question which benchmark reflects real supply-demand balance. That's when narratives shift. There's also a third path. Shanghai could soften materially if regional demand cools, if import channels normalize, if capital flows shift, the premium can collapse downward. That would resolve the divergence without systemic implications. All three paths are plausible. Which one unfolds depends on confirmation data. Now let's discuss psychology. Markets often misprice assets during periods of transition. When silver previously traded around these levels, sentiment was optimistic. Today, sentiment is cautious or even fearful. Same price. Different emotional backdrop. That inversion is notable. But sentiment alone doesn't move metal. Flow does. Inventory does. Delivery does. Capital allocation does. And right now, the key signal is not simply that Shanghai is paying more. It's that the difference is large enough to matter. A $2 premium is noise. A 10 plucas premium is a conversation. Now here's the deeper structural issue. Global commodity pricing ultimately converges. It may take time, it may involve volatility, but sustained divergence between major exchanges eventually forces alignment. That alignment can happen in either direction. Western futures rise, Shanghai falls, or both adjust toward each other. When it happens, it tends to move decisively. Because markets hate unresolved tension. So what should you watch? Watch the premium itself. Does it hold above $10 consistently? Watch registered inventories. Do they trend lower or stabilize? Watch delivery percentages in upcoming major contract months. Watch cross-asset liquidity, especially Bitcoin, dollar strength, and real yields. Watch industrial demand indicators. The story is not about choosing sides between paper and physical. It's about understanding which inputs dominate at which time. Paper dominates short-term volatility. Physical dominates long-term equilibrium if supply is genuinely constrained. And that if matters. Right now, the system is not broken, but it is under stress. And stress, when persistent, creates opportunity. Or repricing. Same metal. Two prices. That's not noise. That's information. The key is waiting for confirmation before drawing conclusions. Because when the spread finally resolves, it will tell you which side was leading price discovery all along.